Hey everyone, Mortgage Nerd here. So the FHFA, that's the Federal Housing Finance Agency, just released a new refinance program. This program is for lower income borrowers, people who didn't have the opportunity to refinance in 2020. Now, this is the same agency that said that we needed to add 0.5% to all refinances in 2020, towards the end of 2020, because of an adverse market fee. And so they increased our rates, and now they're saying, well, for those of you who are lower income, which is 80% of the median income, whatever your area's median income is, then you qualify for this. They're gonna waive that 0.5% fee, so your rate's gonna be a little bit lower than everybody else's. Because remember, that 0.5% is not 0.5% on the rate, it's 0.5% as if though it was points, which might be an eighth or 1/4%. Really what you have to do to qualify is you have to lower your rate by at least 0.5% or your payment by at least $50. That's really easy, especially considering that in Florida, which is where we do most of our business, you want to lower your rate by at least 1% most of the time. Really, the calculation is based on how long does it take for you to recoup your closing costs? In other words, for the savings on the refinance to surpass your costs, you do that math, you figure out how many months it takes, and then you have a good idea of if it's a good refinance or not. So the VA, the Veterans Administration, has the only rule that I've seen that really is a good rule because the VA protects their veterans, the borrowers, and what they say is you need to recoup your closing costs within 3 years. So whatever that savings is total, let's just say your savings is $3,000, right? Your closing costs are $8,000. 3 years of savings is $9,000. So your savings of $9,000 surpassed your cost of $8,000. That's a good refinance in the eyes of the VA. Now, a lot of the refinances that we've been doing over the last year or two, you're recouping those costs in 1 or 2 years. In Florida, the closing costs are always higher than other states because we have doc stamps and intangible tax. In Texas, it's much lower. Virginia's much lower. California is super low. But what you have to think about is all those other states, they have, not all of them, but a lot of them like California have state income tax. So they have to make money off of you in states like Florida if they're not charging you a state income tax. Therefore, they charge doc stamps and intangible tax. So this new refinance option is called RefiNow. Yeah, RefiNow, because you forgot to refinance in 2020. Really, I think it helps those people that maybe they were in forbearance in 2020, maybe their income is down. It really does help a certain demographic in there. And I'm positive about this, as in my positive sentiment about the impact that this will have, but only on a few people. I don't think it's really gonna help a lot of people like they probably hope it will help. Now listen, if you like what you're seeing right here, make sure you take a moment, go ahead and click the like button, whether you're in social media or YouTube. On YouTube, make sure you go ahead and click the subscribe, click the little bell so you get notifications on these nerdy videos coming your way every time they do. Make sure you support this channel so that I can create more good content for you. So some more points about this loan is that it's for loan amounts under $300,000. So if you have a $400,000 loan amount, you don't qualify. It's not for FHA. This is a Fannie Mae and Freddie Mac thing, so it's conventional loans that it would apply to. Another really good aspect of this that I like is that you can get a credit of up to $500 on your appraisal. I'm the lender, you come to me, you get your appraisal done, and it's gonna work. You pay for your appraisal up front. The loan's gonna work. We're moving along and we're getting ready to close. Well, guess what? Me as the lender, I'm gonna credit you that $500 appraisal. Then when we sell the loan and it gets sold to Fannie Mae and Freddie Mac, which is what FHFA regulates, those are the government-sponsored entities or GSEs. Anyway, that's where the loans are sold in the secondary market. They're gonna credit us the $500. So that's really good. You're saving $500 on the appraisal. That's if your appraisal is not waived. If your appraisal is waived, then you have no appraisal costs. So that's good too. And it saves us a lot of time in the process. But that's one aspect that's good as well. So borrowers must also not have a mortgage that's higher than 97% loan to value. So when we do that math with your appraisal, Hopefully your forbearance didn't add too much balance to your loan amount, because if that's the case, if we added more balance to your loan amount, then you might be higher than 97% loan to value. But if you're lower than 97% loan to value, then great, you qualify for this. One of the other caveats is you can't have more than a 65% debt to income ratio. I'm not sure how this is gonna pan out and really work, because you're not supposed to be over 45 or 50% debt to income ratio with conventional loans anyway. So now we're gonna say no more than 65? I'm not sure how that's gonna work out. Again, this is just a news article that came out. By the way, this article came from Housing Wire. I had to make sure I source it so I don't get in trouble. And also, your credit score can't be lower than 620. Now, not all lenders accept credit scores all the way down to 620, meaning 640 might not work, or 650, 660, you might have to have 680 and above. There might be what's called overlays, where the lenders add guidelines to the guidelines they're giving us because there's riskier borrowers. I mean, a 65% debt to income ratio, that means if you make $10,000 a month, you're spending $6,500 a month on your housing expenses, your car payment, your credit cards, and things like that. You're pretty tight, because that's $3,500 a month. Well, that's taxes, isn't it? Like when you pay taxes every month, that's where it goes. So how are you gonna eat? How are you gonna pay the electricity bill, the water bill, things like that? So 65% debt to income ratio is really high. Either way, a credit score of 620 also is something that a lot of lenders probably aren't going to take. But at least you know that, hey, if your credit score is not the best, your debt to income ratio is not the lowest, but we're able to save you some money, you're going to save money on those payments, then we could probably make this work for you. Lastly, I'm going to quote the chairwoman for Fannie Mae. You know, look, I'm Hispanic, my wife is Black Hispanic. I'm the type that I don't see it. So maybe I don't know, but I don't see a lot of racial issues when it comes to lending. What I see is people just want to make money. So why are we going to not qualify you because of your skin color? And again, I'm in South Florida. I'm not in other places where maybe it's more rampant. So I'm just saying, I don't see this in our business. It doesn't mean that it doesn't exist. If it does exist, I think it's a really small percentage of what goes on. I do think that demographically speaking, you would have certain classes, socioeconomic classes, that qualify less frequently because they make less money, they're not as educated on credit and how to manage finances and things like that. But here's that quote from the chairwoman of Fannie Mae. Racial and income disparities in refinance take-up rates have persisted for far too long. With this initiative, we strive to narrow the gap. Sheila Bair, B-A-I-R, chairwoman of Fannie Mae's board, said in a statement. We thank FHFA for its strong leadership to help all eligible homeowners reduce their monthly housing costs by taking advantage of these historically low mortgage interest rates. I think it would be interesting to see how many of these people taking advantage of the Refinance Now or the RefiNow program are in minority racial classes. Because I think it would be great to see that, you know, it's a large percentage of white America that gets this loan, because I just don't like always hearing in lending that there's rampant racial injustices. I do understand in other areas there are. Again, I just don't see it. I'm not trying to get into a heated discussion with anyone, but when I see comments like that, it makes me wonder what the motives truly are. I understand low income, but I don't see people in my business turning away people because of race or color or anything like that. So either way, it's a great program. I hope everybody takes advantage of it. I hope we can close more loans with it, because hey, why not? It helps everybody, including the lenders in this space. Phil Stevenson, Mortgage Nerd, thanks for sticking around for a longer than normal video. YouTube likes it when we go more than 10 minutes, and they really like it when you tell the algorithm that you like this, so hit that like button there, hit the subscribe, click on that bell, make sure you get more of these notices. Phil Stevenson, Mortgage Nerd, out.